Great. Continuing from the last section, we ended at the elements of the financial statements. Now we are the first house was the revenue. So you should know revenue. In fact, each of them we have specific standard that talks about it. So revenue. When I pick a set of financial statements or the financial statement that we are going to prepare, it contains revenue. Then E, the first E, so it's expenses. Expenses. Are we saying? The second E contains what? Equity. And then this one is what? Assets. Then finally, a liability. A liability. Liability. So these are the elements of the financial statement. You should know the definition of them. You may be required to define them. Yes. Now, when it talks about revenue, revenue simple means increase in assets. Increase in what? In asset in the form of what? Inflows. So for instance, when you sell your goods and then you receive cash, that's asset increase. So in the form of what? Inflow. So revenue simple is increase in assets in the form of inflow or decrease in a liability when a liability goes down. And then have a revenue in the form of what? Inflows. Now let's go to expenses, basically the reverse of revenue. That one is what? Increase in liability in the form of what? Outflow or decrease in assets. Decrease in assets in the form of what? Outflow. That's a liability. Now I'll come to equity. It's a very stubborn guy. Okay, let me deal with it. Now who can define equity for me? Now before you define equity, let's define capital first. Capital. Capital refers to the resources that the business owners supply to the business or the entity. That's capital or resources. Now, equity. We don't have definition, specific definition for equity. Not that we don't have. The conceptual framework failed to define and give us recognition criteria. Please, this is a topical issue. It came last two sittings in your paper. But we were asked to define equity first, and second, tell us why the conceptual framework failed to prescribe recognition criteria for it. So we normally use the accounting equation. Given the accounting equation, asset is equal to equity plus what? Liabilities, right? That's the accounting equation. So make equity the subject. You can tell me. Make equity the subject. So assets minus liability is equal to what? Equity. So what's the definition? So this is the definition for equity. Anytime they ask you what's the definition for equity, equity is equal to what? Asset minus liability. They're done. So equity is a residual interest. Is what? Residual interest after deducting all liability from where? All assets. So that's the definition for what? Equity. Residual interest after deducting all liability from where? All assets. That's definition for equity. Great. And then we don't have the recognition criteria. unlike asset and expenses, liabilities and assets, where we have a specific recognition criteria. Great. Why? Because it does not depend on its own. It depends on the assets and the liability. So, in fact, we don't have a specific recognition criteria. That's as soon as your assets and your liabilities they move, it will affect your equity. Yes, to affect the equity. So that is it. Now we know equity. Very topical issue. Because we don't have recognition criteria for it, last two sittings the examiner asked, and after the class, I'll project that question for you. Yes. Now let's go to assets. What are assets? This one there, everybody. Assets. Mm-hmm. Assets. Assets, they are economic resources owned and controlled by the entity from which future economic benefit will flow to the entity. That's the basic definition for assets. That is it. Now, what you have to probably bear in mind is the recognition criteria. There are some conditions which must be there before you can record assets. It's very important. Yes, that condition is very important. So before you can record asset on your financial position, that condition must be in place. Two conditions. What are they? And this condition, anytime we wake you up, please you should be able to memorize it or like give it to us and explain it into detail. And anytime we ask you, can the company record an asset? That's the answer that we are looking for. So now let's see. The conditions are one, we call it the recognition criteria for what? For assets. Condition that must be there before you can record assets. You can have assets physical like this. Yes, this is an asset. You can have an asset like this. But if those two conditions are not there, you can't record assets in your books. Exactly. So first condition. Let me write it here. Condition number one, condition number two. Condition number one talks about the economic benefits. So there must be probable, or it must be probable that future economic benefits embodied in the asset will flow to you. So if you have an asset that the benefit does not flow to you directly, you don't have an accounting right to record it in your books. So let's assume that you have an asset, you have a vehicle. Legally, you own the vehicle, but economically, you are not the one using the vehicle, someone else is using the vehicle, enjoying the benefits of the vehicle. In accounting books, that person have right to record it, not you, even though you own it. How we get it? Great. That's why we did the substance what? Over form. Yes, substance over form. Great. Now the second condition states that the cost of the asset can be measured what? Reliably. Here, because of this point, it has devoided a lot of assets from recording or from recognition on the financial position. I'll give you a critical example. Now, this point is saying that the cost of the asset can be what? Measured reliably. So if you have an asset that you cannot determine the cost of it, please don't put it inside the book. The cost cannot be determined. You can't differentiate the cost, or the cost cannot be separated from you. Let me give you an example. Self-constructed assets or internally generated assets. Normally, we find it difficult to determine the actual cost of internally generated assets or self-constructed assets. Maybe your accounting staff versus your IT department, they combine and they form an accounting software for the organization. Now, the cost of these assets, you cannot determine it reasonably. Why? Because one, they use the company's resources. You pay them. So how would they separate the cost of the software from the cost of operations? So as a result of this, you cannot determine it reasonably. Then don't even bring it inside the book. Great. I'm done. Now, I have a question. Let me ask this question. I always ask it. Today I'll ask it. Are labor or human beings in organization, are they assets or they are rather liability? It's a question. So think about it. By the time I finish liability, I'll come back to it. Now liabilities. What are liabilities? Liabilities are present obligation, right? Today, present obligation, liability today. Now, if you are planning to owe somebody, it's not liability. How we get it? If you are planning to owe someone, so that was not liability. So present obligation arising from where? Past events. Present obligation arising from where? Past events. Which will result what? An outflow of what? Future economic benefit. Meaning it will result payment or sacrifice or exchange of an asset. That's liability. However, here too, before you can record liability in your books, there must be two conditions. All these conditions must be there before you can record a what? A liability. Those two conditions that we met here, they are the same here. In fact, these two conditions, because there are a lot of assets, there are so many types of assets, tangible, intangible, there are so many types of liabilities, provision, conditional liabilities, and those stuffs. Because there are so many types, you are going to meet this condition about what? 6 times before you finish the syllabus. So if you understand it here, that's when you reach there, I just hammer it more, then we go, right? That's good. Now, condition number one, here too, it must be probable that future economic benefit will flow out of the entity. So that means before I can tell myself that I have a liability, I have to assess that or I have to know that I will pay. It will result in payment. Maybe if somebody dash you maybe money and you thought the person like will take the money back. Meanwhile, it's a gift. You're not going to pay back. So you have recorded that one in your books as liability. No, there's no outflow. There's no outflow. So take note. Now, the second condition for liability. Now, we can't say that cost of liability. No, you don't say that. Cost of liability. You say what? The amount. So, the amount involved can be what? Measured reliably. So, the actual amount of the liability, you can measure reliably. So, that is it. So, sister, thank you loan, brother, thank you loan should not be in the books. How we get it? The same way, sister, thank you asset, brother, thank you asset should not be in the books. Those stuffs. Great. Now, let me come back to my question. Are human being asset or their liability? Think about it. To the organization, are they asset? Mm-hmm. Are they asset? Because they work out of their input or output, generate the cash flows for the organization, right? Okay, the organization pay them, so it will result outflow of what benefit moving to them, right? So are they liabilities or their asset? Tell me. Mm-hmm. Great. Okay. Think about it. That question will come back again. No? In fact, before you can answer this question, anytime they ask you, can they recall something like an asset or liability? In fact, if you start by saying yes or no, you have deviated fully. Why? In fact, tell us the condition first before you make the final conclusion. So first, tell us that, oh, before the company can record the human beings or the labor force as an asset, two conditions must be in place. One, there must be economic benefits moving from the human beings to the entity. Two, the cost of the human beings can be measured reliably. Full stop. With respect to the above, even though there will be economic benefits moving from the human beings to the entity, the cost of human being cannot be measured reliably. Full stop. And hence, we cannot record assets. That's all. How do you get it? So they didn't say no. I give the condition, even if the final conclusion is wrong, the condition that you stated qualify with some marks. So take note. Now, because this topic, conceptual framework and regulatory framework, is a written or theory-based paper, the questions, they are moving gradually from theory to what? Practical questions. The last three sittings, I've gone to the last three sittings question. The question wasn't the same as the previous ones, which was a theory-based. I'll walk you through. The last three sittings questions was a practical question, scenario-based. So like how I ask you this, and then you'll be fine. Great. So I'm done with the element of the financial statement. Let me quickly run through the next content. This is content number 4, right? Content 4 talks about the element of the financial statement. Content 4. And then you are going to content 5. Content 5 talks about recognition and measurement. I've done it. Recognition and measurement of the element of the financial statement. So recognition and what? Measurement. So recognition and what? Measurement of the element. Now, we are going to use some terms in the financial reporting paper. The word recognition, the word measurement, you should know and you should understand it so that anywhere the examiner uses it, you are okay. Anywhere the examiner uses it, you are okay. Now, the term recognition, what's the meaning? To recognize. To recognize, to record. But recognition simple means to reflect, process of what? Recording or reflecting or including an element in the financial statement. So that's recognition. So recognition simple means we are recording that item or we are going to account for it in our books or in the financial statement. That's recognition. Then what about measurement? Measurement. For measurement, the value. So now, are you going to record it? Oh yes, it must be recorded. Yes, it must be recognized. What value? Oh, it must be recorded as 20 Ghana cedis or 30 Ghana cedis or at fair value. We are done. That is what the measurement. So measurement talks about value. Good. Now we have the specific recognition criteria. We've done with them. You should know the two. But for revenue, because there's a specific standards on revenue, I wait and then do it there. That's IFRS 15. Asset, there are specific standards giving us specific recognition criteria. Liability to the same thing. So when I go there, I'll use the standards, the IFRS is to deal with it. So I won't touch it. So now I'll go to measurement. What are the measurement bases? There are 4 measurement bases. We call it subsequent measurements or measurement after the initial recognition. It's very topical. Now, how to derive the value of an asset or liability? That's what we are talking about. How to get the value of asset or liability subsequently after their initial recognition or the initial purchase. If you buy assets today or you buy PPE today, exactly a year after, what will be the value? Exactly 2 years after, what will be the value? Will the value still be the same as the initial amount? So that's what we mean by what? Measurement basis. The conceptual framework prescribed 4 measurement bases, the 4. So let's start with the first one, the 4. The 4 measurement what? Bases. The 4 measurement base. The first one is what? The historical cost. Historical cost. So first one is the historical cost. Historical cost. In fact, as soon as you mention this or any of the measurement, the 4, they prescribe how assets and liability should be measured or the value should be obtained. So when you mention it, you don't need to talk about it plenty. Tell us how assets should be measured, how liability should be measured. You are done. So if you and the historical cost, asset must be measured at this, liability must be measured at this. You are done. That's what you are looking for. Historical cost simple means use what the original cost of the item. So you are going to record it at what original cost of the item. For instance, if I bought an asset, let's say 30,000 cedis 5 years ago. 5 years ago, the asset cost 30,000. Today, the value of the asset is 20,000. If I'm using the historical cost, even though the value is 20,000, I'll use what? 30,000. That's the original price. Historical, history, original. That is it. We are done. Liabilities must be stated as the amount needed to settle them in an ordinary course of activity or ordinary course of business. We are done. So assets must be stated at their what? Your original prices, original cost, or historical cost. And then liability must also be stated at their what? At the amount required to settle them in an ordinary course of what? Business. So liability. For instance, if you are owing someone, you pick the money some years back, and then At the normal course of business, how much you need to pay the person? Record it. That's it. Not the current value of the liability. Normal. That's green. Now the second measurement basis, you will know the advantage and disadvantage about this measurement basis. Is a very topical issue. The second measurement basis was using the current what value or current measurement. Current value. Current what value. Current value or current measurement. Current value or current measurement. That's it. Now, the current value, like asset, tell us. Liability, tell us. We are done. So tell us how assets will be measured. Tell us how liability will be measured. That's all. So under each of them. So under the current value, and we're using the current value of the assets, all the past history, clear about it. So here we use the market price, the fair value, market price, going rate, they are the same, using the current value of the assets. Now, assets must be stated at their what? At their fair value or at their current value. Asset must be stated at their fair value or what? Their current value. Asset must be stated at their what? Fair value or market value or current value of the assets. The current value of the assets. That is the what? Current value base. What about liabilities? Liabilities must be stated at the amount required currently to settle them. Liabilities must be stated at the amount currently required to settle them. Great. So if you owe somebody maybe 5 cedi, you pick a loan 5 cedi, and now the loan, the interest has accumulated, and now it has even formed billions. Now you need billions to settle that 5 cedi liability. So the current value, have to record what? The 5 billion, not the 5 cedi that you took from the bank. So take note. So you need to know this, then you are fine. The third one. Now this and this is what? The opposite, right? This and this is what? The opposite. Have you seen? Where here we are using the past detail, here we are using the current value. So that's what? The opposite. That's green. Now, we are going to the third one, third and fourth. So you should know the advantage and the disadvantage. Current value. If you use the current value, it means that your assets are up to date. It will show the actual value, your current value. If you use the historical cost, it will not show your true value or your true performance. Now, the asset value is 20, you are still using the old amount. It won't tell you the actual value of the organization, and selling the business or doing combining acquisition measure will be very difficult. So take note of them. Just that historical cost is so easy to determine the figure. Yes, there's no need for market assessment. Or the current value, you have to assess the market and know the market condition or the asset condition before determining what the fair value. Great. Now let's go to the third one, and then you'll be fine. Third and fourth, and then we are done with what? Third and then the fourth one. Now the third one is like this. Net disposal slash what? Settlement value. Settlement value. So it goes like this. Net disposal value or settlement value, you know. So that one to start. Assets, liability. How we get it? Oh, sorry, I'll put that first. Good. You didn't want my put the first. Great. Now assets. Assets move with what? The net disposal value. So assets must be stated at their what? Their net disposal value. Liabilities must be stated at their what? At their settlement value. That's all. Everything. So that's the name. It's net disposal value or what? Settlement value. So assets must be stated at their NRV, net realizable value. The amount that when they dispose it off, the proceeds, the amount that they realize from it, that is how much they should what state the assets. So like I bought it 5 years ago at the cost of 30,000. Now the value is 20,000. Now I can sell it for 15,000. So because the NRV is 15,000, I will state it at what 15,000. That's the net disposal value. How do you get it? That's great. The liabilities must be stated at the amount currently required to settle them. The current value to settle the liability. So that is it. So liabilities must be stated at their what settlement value. Liability must be what stated at their what settlement value, whilst asset must be stated at their what net disposal value. We are done. Now let's go to the last one, the fourth one. But I don't want to click this one. Yes, 15,000 NRV. Now the last one or the fourth one is what? It's called discounted cash flow or the present value of cash flow. So discounted cash flow. Cash flow. Now asset must be stated at what? At the present value of the cash inflow. That's the value used. Cash what? Inflow. So all the cash inflows, the present value. So when you use the asset, all the funds you are going to generate from it, present value it, and then start using that one as the value of the asset. What about liability? Liability too must also be stated as what? The PV of the cash outflow. All funds that you need to settle them. The present value of all amount required to settle the liability. So PV of what? Outflows, cash outflows. You are done. So have you seen the difference? So these are the four measurement bases prescribed by what? ISB conceptual framework. Some few years ago, like 5 to 10 years ago, it was very topical. It was running. Almost every sitting, the examiner must ask it. You will see it. Great. Now I'm done with the measurement basis. So left with one last topic. Then we are done with the conceptual framework. Now enter into what? The regulative framework to clear it. Then I'll start the question solving. Because after today, I won't come back to conceptual and regulative framework again. Next week, we are starting with the standards. That's fine.
You are starting standards again.
Who knows?
The last time you did standards, tomorrow you didn't even do any
I will be sure. Okay, so if I have any question, kindly let me
You
know.
didn't finish the standards.
If I have any question, kindly let me know. And then everything will be fine. That's great. Now the next one is concept of what? Capital maintenance. The concept of capital maintenance. That's the last content. Content number 7, according to our syllabus, like what you need to know. The concept of what? The capital maintenance. The concept of capital maintenance. Great. Now, that content explain how organizations or companies should define their capital and the ways that we should what, maintain them. That's the basic idea. So, like you tell me how you define your capital, we will tell you how you should what, maintain your capital. That's the concept. Uh-huh. And then we define capital from a different angles, by just that we are going to look through two of the angle. So that is the basic aspect of it. If you want to get a full version, kindly visit the video. Get a full version. Yes. Now we have concepts or types of what? Capital maintenance. So let's go through them. We have the money, money capital maintenance, money capital maintenance, and then we have the physical capital maintenance or the operating capital maintenance. Great. Now the money capital maintenance, it talks about your net assets. Now, Before I do that, you know that in elementary, when we started accounting, sole trader had sole trader prepare their financial statement, especially the equity section. So capital at start, right? So capital at start, maybe 200 Ghana, no, 300. Add net profit, right? Net profit. If you add net profit to it, what do you get? Maybe net profit of 100 Ghana cedis. Additional capital into this, maybe that owner brought additional money. He brought 50 Ghana cedis. Draw is, yes. Maybe he brought money and took some more, yes. He took place say 80 Ghana cedis. What was the closing balance? Mm-hmm. So that's the closing balance of the word capital. Now, the money concept or the financial capital or the money concept explain or define how profit is being earned by entity. That's all. So you tell me how you define your capital, I will tell you how to maintain it. That's what you're going to learn about the capital maintenance. And then there are various ways of defining capital. First of all is the money or what financial. It talks about the net asset. That's using the net asset. Now, what's the closing capital? Mm-hmm. So 400. 320, right? So that's 370. That's good. That's the closing capital. 370. Now, we are saying that with the financial capital, profit has been what? Earned. Profit has been earned. Is the difference between what? The capital at the end of the year and the capital at the start of the year, excluding what? Distribution made to or made from owners. Let me take it again. With the financial concept or with the money concept, it talks about net assets. So it compare your net asset. This is a net asset that we are talking about. It compare your net asset that you have at the end of the year. Maybe at the end of the year, my net asset is what? 370. Meanwhile, at the start of the year, the net asset was 300. Okay. Now, capital has increased, or profit has increased, or we've made a profit. If and only if the capital that we have at the end of the year is what? More than what? Or is greater than the capital that we have at the start of the year. Excluding what? Taking consideration or excluding distribution made to, this is the distribution made to the owners. Or distribution made from owners, additional capital introduced. How we get it? So it means that if I compare the opening balance of capital to that of the closing balance, with that considering these two guys, and then still it has increased, then we have made a profit. So here, profit is earned if the net assets at the end of the year exceed what? So let me write the formula. Here, profit is equal to the net assets, the closing balance of the net asset. Net assets at the end, at what? End, less at the beginning. Have you seen? That is it. So if the net asset at the end of the year is more than net asset at the start of the year, excluding what? Any distribution to or from the owners, then we've made a profit. That's the financial capital concept. That is it. So we've made a profit. Great. So that is it too. Now the next one that we'll talk about, the next concept is the operating capacity or the physical capital concept, the physical or the operating capacity. As the financial or the money concept talks about your net assets. Now, with the physical also talks about your operating capacity. That one talks about what? Your operating capacity. If your operating capacity at the start as compared to the at the end as what? Increase without contribution of what? Contribution made from or made to the owners, then you've made a profit. So for instance, at the start of the year, your production unit was, let's say, 5,000. Here we use unit, production unit, your operating capacity. If you're able to produce more than what you have at the start of the year, then you've made a profit that year. But if you produce less than what you have at the start of the year, then you make a loss that year. That is the fiscal concept. That's the fiscal concept. That one talks about what? Your operating capacity. Meanwhile, the financial talks about your net assets. Have you seen the difference? So, with the financial, when your net asset increases, you have made a profit. With the operating capacity, when your operating capacity increases, you've made a profit. That's the difference. That's all. We are done. Now, that does not mean that we have only two concepts of capital maintenance. There are other, but these are the main two that we talk about. The remaining ones are there for you for homework. So now on that note, we are done with what? The conceptual framework. I will start the regulatory framework right now and finish it so that we go through our questions. Then you'll be fine. To get a full picture, kindly visit or use the video. Great. If you don't have the capital maintenance video among the list that I sent, kindly let me know. Then let me add it to the list. Because all of them, there are videos on them. Great. Now we are going to do regulatory framework of financial reporting. We are now in the conceptual. Regulatory or framework of FR. What we did first was what? Conceptual. Everyone talks about what? Rules. Conceptual talks about what? Principles, assumptions, basis, practice, convention, tradition that we have to adhere to or that form the basis of financial reporting. Now you're going to talk about what? Regulatory framework, rules, and some laws govern financial reporting. That's all. So what you did first was the concept and principles. Now you're going to do what? The rules. So now tell me, what are the source of law for financial reporting in Ghana? Ghana, what are the legal or what are the rules or the legal backings of financial reporting? What are the source of law? One, source of law for financial reporting. Can you tell me one? Yeah, the company's code, right? Who can tell me the full name, the full act? Company's code. Act. Oh. So the Companies Act 2019, bracket Act what? 992. So don't forget. That's it spells out or tell us the account that must be prepared. It gives us the legal backing. In fact, the company's code gives you the authority, and then the IFRS give you how to what prepare the financial statement. How do you get it? So it's like someone telling you that do this, and someone else will come and teach you how to do it. Have you seen? Good. So company's code is giving us what? The regulatory framework. It tells how the account must be what, when, and then the auditing, the process, and then the issues surrounding what, the account preparation. All of them are stipulated in what, in the company's code. So take note, the company's code. Now two, they also get from what, the stock market. They also get it from where, the stock market, the stock market, or the stock exchange. So Ghana Stock Exchange, you can get from there. So if you're a listed company, you also get some of your rules from the stock markets. Then you can also get some from where? The Africa Union's directives or instructions coming from where? European Union. They also give us those instructions. They can also get some from where? The conceptual framework. Wow. Yeah, some of the rules are in the conceptual framework. Those, wow, we are done with this. So you are done with this, you are done with this. This one, the act, you have to read the entire act. You have to also read the requirement. This one, you are done with it. So you are done with all the three. Oh. That's good news. Kind of know. Then the last one, we also get from what the financial reporting standard. The big guys, the IFRSs. Yes, we also get rules from there. So in Ghana, this is the four or five source of what the laws or regulation of our financial reporting in the country. Ghana here, Ghana. Yes. So now, in fact, this topic regulatory framework basically talks about the IFRSs. Basically, that's what we're going to talk about. Because looking at this, the company's code is there, you can read it. Stock market, the risks are also there. Without the conceptual framework, so what we've not done is what IFRSs. So basically, the regulatory framework talks about IFRSs. Now let's single them out and then deal with them. And then you'll be fine. Great. IFRSs. IFRSs. Now before I do that, why do you think there will be need of regulation or regulatory framework? Why should the Ghana government spend energy to come out with acts, companies code, stock market? If someone has got his money to set up a business, allowing him to trade them, why are you giving us act to regulate such their activities? So that's the need of what? The regulatory framework. What's the need of regulatory framework? The need of the regulatory framework. Why do you think they are rules, they are IFRSs? Why do you think they are companies code? Why do you think it's not free? Why do you think it's not free? You can just set up any business you want, trade, get the money, take the boost money, spend it somewhere, and then be chilling. As you see in Ghana. As again, I don't mention names of company. Yes, because I'm on Instagram. Okay. Now the main reason is to what protect the stakeholders or the shareholders, especially the shareholders, to protect them. Yes, to protect them. The interest of the shareholders must be protected because normally the shareholders or the owners they are not managing the business themselves. They've employed managers. So if care is not taken, they will use the company to enrich themselves. But the owner or the shareholders or the stakeholders might not be what might not be benefited. And also, now, if you are going to invest in China or a Chinese man investing in Ghana, you will consider one thing. Is there any law guiding the company's activity? Because if a Chinese man does not consider that, then anybody can represent something or anybody can prepare something to represent something. No, have you seen? Yes, so there must be what laws govern the activities to suggest that there are controls to attract investors. Because if I'm going to invest in any company outside Ghana, I'll make sure that that country first their rules govern their financials. Other than that, if you pick your money there, don't even go and ask anybody again where is the money. That's why the government probably has stepped in to pay some of the defaulters or some of the collapsed banks the deposit, the general public funds to them. So that is it. Because it's also the state rules to protect what the innocent depositor or the stakeholder is a stakeholder. That's green. So that is it. Now, these IFRSs or this financial reporting standard, we are going to talk about how, when, who formed them, and then those issues, and then you will be fine. So I'll take like a minute break or a second break, a minute break to relax yourself. When you come back, we'll look at the IFRSs into detail, and then you'll be fine. Great. Okay. Now, there are some big people, big people, extremely big body, like experienced accounting professionals. They sat down to develop these IFRSs. So, what are the governing structure or the board? So, in fact, the IFRS Foundation is the body that's supposed to what come out with the IFRSs. Is a body that is supposed to come out with the IFRSs. That's the IFRS Foundation. That's the body that's supposed to come up with what? IFRSs. But sometimes if you have a lot of responsibility, you can delegate some towards other people, or you can just instruct other people to do some of them for you. So, sorry, but you. So the IFRS Foundation, they're supposed to set the standards. But they say, oh, we can form a board and that board have more experts so that they won't do any work apart from setting the standards. So the IFRS Foundation formed a board. They form a board so that the board will solely set what the IFRS. So they form, so they appoint members onto the board. So they appoint, so they form a board, and then we call that board what? International Accounting Standard Board. The IFRS is what? International Financial Reporting Standard. Are we saying IFRSs? So the IFRS Foundation. In fact, these people, their role or the function that they perform towards the bodies, they do what? They appoint, one, they fund, and what? They govern structure, and what? They oversee the activities of what? They oversee the activities of the board. So now let's see. Have you seen the structure? Even though there are some top guys, this IFRS Foundation, there are other bodies that supervise them. We call them the monetary board. Yeah, the monetary board. The monetary board is on top of the IFRS Foundation, even though IFRS Foundation is also on top of what? The ISB board. Now, if someone if someone funds you, appoints you, and that person can also sack you, yes, and that person govern you, that person supervise you, then what do you do to the person? You also provide what? Report. If the person reports, so they also owe the report. Have you seen? Great. So they also provide report to what? The ISB, the IFRS what? Foundation. The main responsibility of the board is to prepare and issue what? IFRS, the financial reporting standard. The IFRS. That's the main. But they don't do anything. When you wake up, whatever they do is what? Do the IFRS. That's all. They don't do anything again. Don't forget that we said that they are the same people that brought what? The conceptual framework. So they are the same people that set the principles that will be used to set the IFRSs and the new affine. So that's the IFRSs. Great. Now, you realize that sometimes they need some advice, some consultation. So they also set, the foundation set some IFRS or advisory council. So advisory council. Advisory council. In fact, what they do, they have to what? Advise the board. They provide what? Advice to what? The board. That's the ISB Advisory Council. They advise the board. Then sometimes the IFRS is not sometimes. In fact, IFRS is that they normally issue. Some of them are what? Complicated. So they have to provide meaning. So they have to be what interpreted. There's a team that oversee that, and there's a team that also look at after, so that after the standard, so that nobody do remix. You know, if guys not taking the one, give her their own requirements. The standard is saying do it this way, them to do it different way to suit their own preferences. So there must be need for interpretation committee. So interpretation committee, then you are done. Good. You have to also what, interpret what the IFRSs that been issued. So like they provide explanatory notes, understanding of the key principles stated in what the IFRSs, so that you won't do what you like. Because in fact, if you give the chance, they'll create what photocopy of the requirements. That is it. Now this is the IFRS structure or the ISB structure. And now you know who sets what the standard. Now you know who oversees the activity. In fact, these people do they have head though. We call it what? Monetary board. So the monetary board is on top of the IFRS foundation. So there are some people also more like govern and then supervising the activity of the IFRS foundation. So these big boss do they have their senior boss there. That's the monetary board. You know the IFA is a very giant body, and there are a lot of boards, a lot of committees under the IFA. That's the International Federation of Accountants. Yes, that's fine. So now that is it. Now, have you seen their responsibilities? The role or the functions performed by this and this guy are not the same. This guy will say, okay, appoint members onto the board. You are done. Fund them, give them the resources that they need. Provide policies, instruction, clear instruction. Use your rule. Now, supervise them well. Then let them provide report to you. These people do their sole aim, or the board, their sole aim is what? Issue the IFRSs. They are done. Everybody in their responsibilities. Good. However, because these people, they are the ones that's supposed to prepare the what? The IFRSs. And now they what? Appoint somebody to do it on their behalf. So it means that these two people, they have what? Common objectives. So the objective will be one, just that their functions are different. Now let's learn the objective of what? The IFRS foundation. For the objective are what? I'll give you three. Go look for the two. Add it, making five. I won't give you all. Yes, that's great. If you read the books, in fact, I've stated four in the book. So you can add the extra one. But I need five, not four in the book. Now, so the objective of the board, International Accounting Standard Board, and objective of IFRS Foundation are what? The same. They have a common objective. So what are they? Objective number one. Objective number one. So let's see the objective of what? The board. Objective number one. To develop high quality, globally acceptable accounting standard. So that's the first objective. To develop what? High quality. To develop high quality, globally acceptable what? Accounting standard or financial reporting standard. So that is it. So the standard must be what? Quality. Globally what? Acceptable. How do you get it? That's great. Okay. Now, that's the first objective. That's objective number what? One. Objective number one. Now, objective number two, to promote the use of the IFRSs. Yes, that's the objective of these two guys. To promote what? The objective of the use of the IFRSs. To promote the use. After the publication or the issue, they shouldn't go and sleep. They shouldn't go and sleep at all. They have to like sell the good news about the IFRS so that a lot of people, a lot of member states, a lot of countries, a lot of institutions will adopt the IFRSs, right? Yes. In fact, there's an adage that even ghosts, they want to multiply themselves. How can they be the living ones? So let's sell the kingdom, or let's sell the good news about what IFRS. So there are a lot of people who adopt it. So that's the second objective, to what, promote the use of the IFRS. Then the third one, that will be my final point I'll give you, but that's your third point. You're going to do for two. That's great. Now, the third point is that to limit the alternative treatment of accounting transactions. To limit what? The alternative treatment. That's another objective. So that they can provide what? One standard way. Good. So to limit what? The alternative treatment of accounting transactions. If not because of the IFRS, idiot, just give one transaction and call 10 accountants. All of them will give you 10 different treatments. We don't want to see that. We want to bring standardization so that you can compare. The financial statement prepared in Ghana can be compared to that of South Africa. So if South Africa are doing whatever they like, Ghanaians are doing whatever you like, Nigerians will do their own. We can't compare the performance. No. So that is it. So to limit and prevent the alternative treatment, you should have just one best way to treat a transaction. We are done. So that is the objective number 3. Objective number 4 and 5. You are the one going to put it down. Please. I'll take them all. That's good. I am done with the conceptual framework. Now let me give you a brief history. I'm done with the IFRSs. Let me give you a brief history. Why the standards that issued by the board, some of them are called IAS and some of them are called what? IFRSs. Now let me give you a brief history about it. Now that's the history of the day. Oh. Yes. Please, no examiner will ask you, so let me tell you first. We don't need a history, but to probably help us to understand them well. Now in 1966, something happened. 19 what? 66. 1966. Some group of people said that, can we have some rules or some principle governing our financial reporting or our accounting? They said yes, it's good. Let's come out with principles or accounting or IFRSs. So they started. You know that when they said that when COVID enter your body, you take out in this 14 days, right? Yes. So them two, they took 7 years. Take them 7 years before they start issue the IFRS. So in 1973, they started issue the standards. So 1973, that's where they started issue what? The standards. So the first standard they issue over there, they call them what? IAS. So let me write them here. IASs. So that means International Accounting Standards. Great. So they started, IAS 1 was issued in 1973. So the standard that you are going to learn, the first of them, or the first one was issued in what? 1973. So at that time, there was no IFRSs. At that time, there's no what? IFRSs. At that time, these people, they are one. There's no difference between them. They are called what? International Accounting Standard Council. It was not a board. So from 1973, it was called a council. Have you seen? And then here too was the same council. There's no difference between these two guys. How you get it? How you getting it too? Now, so they issue 41 standards. So in 2001, April 1st April 2001, something happened. What happened there? History must repeat itself. April 2001, they realized that some of the standards, the IAS that they issued, were no longer applied. Imagine you setting standard in 73 and then in 2001. How many years? Will that standard apply? No. So some of them were not out of use, outdated. Some of the principles were outmoded and then no longer fit in the context of 2001 economic status. So there's a need for revision. So they do what you call major overhaul. Obviously, they change everything. So now, they started deleting some of the IAS. In fact, between 73 and 2001 April, they issued 41 standard. 40 what? 41. So starting from IAS 1 up to what? IAS 41. So IAS 1, IAS 2, IAS 3, in fact, they did well. So from 73 up to 2001, how many years? 41 standards. They did well. Now they started deleting. From April 2001 to today, they are deleted and they will delete all of them. Now what happened is this: when they delete IAS and they want to replace it, or they want to bring a new standard, that new standard will bear the name IFRS. So now IFRS now started from April 2001. We start calling them what? IFRS. International Financial Reporting Standards. No more International Accounting Standard. Then these people saw that no, why can't we call ourselves a board? So let's call ourselves a board, not council. So then they change their name to what? To board. They changed their name to what? Board. Now they became what? Board. For this one, formally, they are also committee. It was a council. Now they changed to what? A committee. It wasn't a committee, it was a council. Now this will maintain their name. This will maintain advisory council as an advisory council since we started. It has an advisory council. And then we now have IFRSs. So in short, IFRSs are the standard that one issued after 2001 April. Two, they are the one that replaced the one out. So some of the IFRSs are new. Some of them too are there to replace the IAS. In fact, the IAS, out of the 48, we have only 28. So out of the 41, we have only what? 28. They've deleted what? 13 from the system. In fact, 50 to 100 years ahead of us, all the IAS you go, they will cancel all of them. They will cancel all and bring what? IFRSs. That is why when you check the number of the IASs, they are not in order. For instance, we have IAS what? 1. It's not coming. Let me do it here. For instance, we have IAS 1. We have 2. We don't have 3. Cancel. 4. Cancel. 5. Cancel. IAS 6. Cancel. IAS 7 is there. 8 is there. 9. Cancel. 10 is there. 11. Cancel last 2 years. 12 is there. 13. Cancel. 14. Cancel. 15. Cancel. 16 is there. 17. Cancel last 2 years. Have you seen? So they've canceled because if you are getting older, they will delete you. But when they are bringing a new one, they name it what? IFRSs. Now the IFRS have from 1 up to what? 16. But the truth of the matter is that they are not done with 9. IFRS 9, they are not done, but they are done with what? 10, 11, 12, 15, 16. For 17, they are done. They are about to publish it. 17, go and look for it. It is called what? Insurance what? Contract. Insurance. It's about insurance. They'll publish it soon. And it will become a topical issue. So this is a brief history about what the IFRS. Why a set of standards, some are called what? IASs and some are called IFRSs. So take note. So the remaining IAS, some of them are relevant to our studies, together with the IFRS, some of them. So we learn them. At the level 2, we're supposed to know 17 of the standard, combination of IASs and IFRS, 17. Out of the 17, only 5 will drop in exams. So that is it. So now that we know, next week we are starting with the standards. Now the standard, this is how I'll do. Please, there will be videos on all the standards. So what do? You watch a video, when you meet, you are solving questions. So that we don't do the principle here. We rather solve more questions on them. So that the month ahead of us, we used to finish all the standards. Then we start the publications and the console. Then we're almost done with our study. That's good. So that is it. So this is a brief history. So the 17 standard combination of IAS and IFRS should be fine. So that is it. Okay. Now that I'm done with the IFRSs. Now let's go through some few important and some disadvantages of what the IFRSs. But I believe strongly that They use the word financial reporting because the financial report is more stronger than accounting. Because accounting are for bookkeepers, accountant, bookkeepers. But if you say financial reporting, the guy is preparing financial statements and presenting it. That guy is more like powerful than the one that did the recording. Have you seen that? If you go and call somebody accounting clerk, they will just eye you. But if you call him maybe accountant, chief finance officer, then they respond, right? So that's what probably also did that. Now let's see the importance of the IFRS. We call it advantages of what? International harmonization. You should know. That's the importance of the IFRS. Like the good news about the IFRS. Assuming that all countries on this earth or all companies adopt IFRS, what do you think will be the importance? Tell me. So that's the international harmonization of the what? The IFRS. If now from henceforth, anywhere, even if you want to mention the standard, we call it IFRS. We are not going to call IAS again. We call it what? IFRS. So if I mention IFRS from henceforth, it means what? It covers both the IAS and then the IFRS himself. Except for if I want to call it maybe IS2, then I can call it IFRS2. So you have to know that. Great. So tell me the importance of what IFRS is. That's if all countries, all institutions, or almost all, we can't have all countries adopting IFRS, that one know. But if majority of institutions adopt IFRS, what do you think will be the good news? Good news number one, we call it advantages of what? International harmonization. Advantages of international harmonization. Good news number one. Good news number one. It will improve what? Comparability, right? It will enhance or improve comparability. That's the good news number one. So it will improve what? Comparability. It will improve comparability. So if most of the countries are using IFRS, Ghana, Togo, South Africa, Benin is using IFRS. Imagine Benin using IFRS. Chai. So if they use IFRS to prepare their financial statement, that means we can compare performance easily because there will be standardization all over. Financial statement prepared in Ghana can be compared to that of what? South Africa and then the other countries. That's
I
great.
said advantages of international.
Harmonization. Advantages of international harmonization. That if all or the standard is being harmonized worldwide, what will be the good news about it? So one, it will improve what? Comparability. It make comparison become so easy. Performance measurement become so easily. So that is it. Now two, transfer of staff becomes so easy. Transfer of what? Staff. Accountant in Ghana can also serve as what? Accountant in Nigeria. Why? Because the standards are the same. The same IFRS. If they use the same IFRS to prepare financial statements. That's good. Transfer of staff. You can see this one in some of the audit firms. Their partners, maybe partner KPMG Ghana will be transferred to Nigeria. Go and continue your work there. You can see them transfer of partners. This one is common in audit firms. So it's because the standards are the same. If like they should transfer them to Kuwait and see what will happen there. They should transfer them to what? The Arabic countries. They don't accept the IFRS systems. When you go there, you can't just use the sharing laws. You yourself now you come back. Then they should come and pick you. You don't understand what is going on. You be odd. But when they send you to where the same standard is being applied there, wow, you enjoy it. That's great. Okay, that's the second point, right? So point one, improve comparability. Let me write it down so that this section is not coming clear. So point one, improve comparability. Point two, transfer of staff is easy. So one, improves comparability. And then two, transfer of staff is easy, right? Easy transfer of staff. So transfer of staff. 3, it reduced audit cost, of course. Reduce what? Audit cost. If you accept IFRS, when auditors come around, they will not spend much time. More time. The more the time they spend on the audit work, the higher the audit fee because they charge per hour. But if you accept the IFRS, oh, that one is standardized. So they will not spend much time going through the stuff because you are using the standard measure. But if you're using different standard aside the IFRS, then you have to first of all convert whatever, learn whatever you are doing and check whether you've got it correct. So that one they spend much time and will charge you high. Yes. 3. What will be the third point? Hey, sorry, that is the fourth point too. Easy access of finance. Easy what? Access of what? Finance. Easy access of finance. Of finance. Easy access of what? Finance. Great. Now, if you are going to pick, or you are going to contract maybe advance or loan, international loans or international finance, and you don't prepare account using IFRS, I'm not sure they'll give it to you. So I'm highly sure that even some of the African countries, they were forced to adopt IFRS by force on them because they are going for loan elsewhere. Let me take my own country, Ghana. If I go and find out why Ghana adopt IFRS, I'll give you the date. Ghana, we adopted IFRS in 1st what? January 2007. That's where Ghana we adopted IFRS. So homework number 1. Why did Ghana adopted IFRS? Who adopted it? 2007. Who was the president by then? Okay, why they adopted the IFRS in 2007? Is that the same year that we got our money, right? That's the same year that we got the money, eh? Oh, okay. So that IFRS help us to account well. That's great. So, baby, as an assumption, they were going for loan from IMF or World Bank. World Bank told, okay, do you accept IFRS in your state, your country, so that to improve performance comparison, then go back, accept it before you come for the loan. So that's easy access to finance. You'll be internationally recognized, and then you'll be fine. That's good. So basically, and it also improve what? Accountability. 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 Improves accountability. So these are the few important of what? The IFRSs. Now they can make it country specific. We can tell you that, tell us about 5 important or 5 benefits Ghana have what derived from adopting one the IFRS. Tell us since 2007 up to today, what are the specific benefits? Tell me specific. Tell them that 1, it has reduced the audit cost since 2007 to today. 2, it has helped Ghana to secure more finance. Agreed. In that order. So this one will be specific. Specific. Okay, that's fine. Now let's go to the disadvantage of the IFRSs. The difficult of the IFRSs. Now, these difficult, we normally call it barriers to international what? Harmonization. Why is it a barrier? The disadvantage of a particular standard will cause one or two organizations or countries not to accept what? The IFRS. So we call it barriers of what? International harmonization. What will be the standing block, or what will be the cost, or what will be the factor that will serve or that will deter a lot of countries to adopt the IFRSs? Sometimes we use the negative aspect of the standard. So some of countries just look at the negative impact of the standard and use that one to kick the standard in their country. Yes. For this standard, Egypt is not using the IFRSs. You only use IFRSs in Egypt if we're a foreign company. So, for instance, in Ghana, if it's supposed to be in Egypt, the foreign companies, they would rather use the IFRSs, and then the local companies will use the local laws or the local standard. So the local companies in Egypt are reporting using what their Egyptian what standard or Egyptian laws, the country's accounting standards. That's it. Now, in the next meeting, I'll provide you with the list of African countries who have not adopted IFRS and those that have adopted. Please, Ghana, tell me why Ghana adopted IFRS. I need it. Why Ghana adopted IFRS? What was the motive? In 2007, 1st January. ICA started examining in 2008 too. So ICA started examining on IFRS in 2008 because the next day that Ghana adopted it, where they started. Before Ghana adopted the IFRS, you are using what you call Ghana Gap. Ghana what? Ghana Gap. So you heard of Gap. Generally accepted accounting principles. That's the gap. Each and every country have their own. So before 2007, that's what Ghana we were using. So if you like, I can give you a past question. From 2005 past question up to 2007, the standards that they were asking, it was not too con like from 2008 coming, where they started examining on the IFRSs. Yes, that one, the question was very tough and con. Great. So Ghana gap. Now the barriers, they are barriers to international harmonization. Barriers to international harmonization. That's the disadvantages of the accounting standard. So disadvantages, barriers to international harmonization. Now the first one that we say is that different legal system can serve as barrier, can deter some countries to adopt the IFRS. Different what? Legal system. Look at India, their legal system there. Look at Kuwait. Look at South Africa. Look at Ghana. Look at US. Look at other countries. I can give you a critical example. US is using what? Rule based. US legal system is rule based approach. Whilst UK or US, sorry, UK or Ghana, we are using what? Principle based approach. So you can see that is what? They are different. So if your legal system does not support the IFRS, in fact, the IFRS is principle-based approach, not rule-based. So most of the countries that are using the rule-based find it difficult to accept the IFRS. In fact, I will explain rule-based. Rule-based and principle-based. Here with the principle-based, they will sell the principle to you, tell you the good news about the principle, and willingly you what? You apply or you adopt it. So that is it. How are you going? Great. But with the rule base, you either what? Comply or where face the punishment. That is it. With the rule base, either you comply with the rule or go and face what? The punishment. You are done. Great. So different legal system will deter a lot of countries. And then you can also talk about the need of financial reporting. Need of what? FR. Some country, the reason for preparation of financial statement different to that of a different country. Let me give you an example. Some country, if you owe the government, that's where you have to prepare financial statements. So if you don't owe the government, don't prepare any financial statement. Some country, if you're going to pay tax, that's where they don't prepare financial statement. Some country, you only prepare financial statements if you're a company, like Ghana. You're a company. That's why you have to prepare financial statement annually. Great. So each and every country have a different need of FR. So why should we adopt the FR? Now some of the country, their need is not to provide information. So such a country will find it difficult to what? Adopt the IFRSs. So the needs are different. So different needs of what? Financial statement or FR. The needs of the financial reportings are different from country to country. So it will deter some countries for adopting it. Oh, this IFRS is there to provide information or make accountability. First, we know ourselves, so nobody will steal. So what do? We only prepare financial statements if and only if you owe the state. So there's no need for us to adopt the IFRSs. Great. Now the next one is culture differences. Culture or differences. Look at the culture of India and the culture of South Africa and Ghana. How can one principle or one law govern all of us? Look at the culture of Kuwait and some of the Arab countries. Look at the strict laws that they have there. So their system, their culture, if a Chinese man see that whatever the IFRS is saying contradicts his culture, he will throw the IFRS and down, go by his word, his culture. Look at a Chinese man. He prepared the nicest spoon ever on this earth, but he still prefer to use with what the chopping sticks. And our Ghanaians are learning how to use the chopping sticks and then the spoon, throwing our hands away. If you go to a restaurant and go use your hand to eat, they will laugh at you. Yes, they will laugh at you. Yes, why? Because you copy the other culture, right? Great. These cultures have influence on their financial reporting. So if it is a country that they've realized that our culture, we will sell our culture for this IFRS, we will not accept it. So serve as what barrier because they are different what culture or behavior, and it have influence in what in the account. In the account. Great. But I've mentioned two things I've not recorded though. Three, culture differences. Great. Now the fourth one that I'll talk about is what? I'll talk about nationalism. Nationalism. National. So nationalism. One country is not ready to accept other countries' item. For this one, there is a global issue. That what led to what the world was, right? Doing. Now US is for example, USA have not adopted the IFRS. Why? They are saying that their US gap is far better than the IFRS. Why? But the IFRS is coming from where? UK. So they don't want to accept it. These two countries. Now, there's a formula that we use to predict failure of a company. US have their own formula to predict the failure of a company. UK have their own formula. And all the two, what? Africa, what happens is that we learn all the two. So that's why some of the English word you see, UK version, what US version. But now we combine the two, right? And say it. So that's why we speak UK version English and then we type US English because of all our keyboards are what US keyboard. Yes. So that's when you type, they align it with red letter for you know it's correct. So that is it. So one country is not ready to accept the other country's item. So US have not accepted the IFRS. US, for example, have not accepted the IFRS because they feel like it's coming from where UK. But UK is saying that this IFRS is made up of what? It's coming from IFAC, International Federation of Accountants. It's not no country owns this IFAC. It's non-governmental institution. Just that US is saying, oh, but we know the roots. In 1966, where did they start the program? 1973, where they started the first IFRS. Where's the headquarters? You know everything. Oh. So that's what US is saying. Still, now what IFRS law or the IFRS Foundation, what they've done is this. IFAC have sent professors team to US to analyze the US IAS or the US gap. That's the US standard, the gap that US is using. They should analyze the US gap, that's the US generally accepted accounting principles. And then they should find the differences between the IFRSs and then the US gap. So that the ISB will come and delete the differences in the IFRS. So automatically, the US gap and IFRS become all the same. So they've accepted it, right? Indirectly. So that's what they are doing. They started, we call it the convergence between what? The US gap and then the IFRSs. That's the ninth program that they are doing. They'll finish soon. So you are finding the difference. Five. As it stands, there are five topical differences between the US gap and IFRS. If they can delete these five differences between the IFRS and the US gap, now it will be the same. So I'll leave the difference for you. Go and look out for the difference between what the US GAAP and the IFRSs. Great. Now the fifth one is what? Cost of training and retraining. Cost of what? Training and then retraining. Cost of training and retraining. Now in 2007, Ghana have to spend money and other resources. Train professors from the various institutions, universities. Get a lot of resource personnel to come and train them on how to learn the IFRSs and use the IFRSs. ICA, for instance, have to organize seminars, conferences to teach how the IES will be what will be used in the country. Meanwhile, there was on that road, poverty was in the country. Oh. Have you seen? They used the money to go and then train on how to use what IFRSs. That's one thing. The next one is what the need of developing countries. Need of what? Developing countries. In fact, what developing countries need is not IFRSs. IFRSs will not solve the poor roots. The IFRSs will not solve the poverty in Africa. The IFRSs will not solve the corruption in Africa. So the need of developing countries, not IFRSs. If we are hungry, we get time and go and report. Not at all. If there's no food in a country, why are you going to sit there and report? In fact, let there be food. Let food be all over. Now, they will get satisfaction. Now, let's assume that there's money all over, but there's no food. When you get the money, what are you going to use to buy? Are you going to see the money? Not at all. So the need of developing countries is not the IFRS. That's a big mistake some of the African countries have done, including Ghana. Now, you have to develop your primary base first. Make sure that the primary activities in the countries are secured before you add a secondary or the tertiary activity to it. Now, Ghana, we have gone beyond our level. We are the tertiary stage. Meanwhile, our both primary and secondary are poor. Primary activities, extraction industry, a lot of raw materials, creation of raw materials. That's what developing countries need. Creation of raw materials, farming activities, farm produce. Then you move on to the secondary sector. Secondary sector are the manufacturers turning this extraction or these raw materials into what? Into final products and then selling it. That's what developing countries need, not the IFRSs. The IFRSs are tertiary. Now, when you go to Western world, some of these primary needs are there for free. Coffee. You can go to any university, work and get some free coffee to drink or free coffee to maybe quench your taste. Come to Ghana, go to Legon, and go and say that you're going to look for free coffee. In fact, my boss told me that if I met someone in Ghana and then he was a student, he was there's bread at one hand and water too at one hand, and you said that you don't know that bread can go with water at the same time. So such a country, but you're still using IFRSs. Uh-huh. So developing countries, their need is not what IFRS. If a country is seriously looking for avenues to develop the country, including roads, schools, they will not adopt the IFRSs because the money they will waste on the IFRS, they will use it to what? Secure the basic needs first, safety first. If there are wars in a country, who is going to report? If Boko Haram started in Nigeria there, are they going to use the IFRS to probably catch Boko Haram? Not at all. We need security first. So the primary settings must be there first. So these are the few what barriers that deter a lot of countries to what adopt the IFRS. I am done. Now I'm going to do the last aspect, and then we are done for the regulatory framework. What level is ethics? Read on ethics, and then I will come and then discuss it before we
Where are the notes?
the ethics. I'll offer them to you. That's great. That's a good question. Now let's move on to the standard setting process. Now we know the importance of the standards. We know the disadvantages. We know even who set the standard. We even know the years that the standard was set. And we even know Ghana when we accepted the standards. Great. So now what are the process that the IASB normally goes through to what to set the standards? So that is it. So we call it standard setting process. We have given it a nickname. We call it the due process. So the due process. So the process that the board normally goes through to set the standard. What are the process? The due process. So let me write the due process. The due process. So if I dey go through seven stages before they set the standard. Please, this process, they are the same for both new and what? Revising existing one. So you don't have different process for new standards and different process for what? Revising existing ones. I hope you get it. Great. So there's something that can trick you that ISB want to revise IAS 16 due to complaints made by some of the member states. Suggest the process that IASB will go through to what? Revise the IAS 16. And then they can be. If IAS 16 want to come out with the new standard, give us the process. These two questions are the same. The same process. So take note. Step 1 or stage 1. So step 1, first, because we call it agenda consultation and plan of work. Agenda what? Consultation and plan of work. Yes, everything that you want to do, you have to consult. Consult for ideas. Go and seek for ideas. Yes. So first, agenda consultation. Agenda consultation. And plan of work. Plan of what? Work. You have to plan the work. That's the first step. How did they consult agenda? They consult agenda in two ways. Agenda simple means what? Ideas. How they consult ideas. How did IAS, the board, in fact, the board is the one that set the standard, so they go through this process. So how do they consult ideas? Two ways. Internally, let's say the internally, they will go to advisory council and then schedule for meeting and say, hello guys, you want to come out with IFRS 16. Kindly give us your opinion. Oh, okay, let's start a new standard. IFRS 40. Preparation and presentation of what? Marriage accounts or marriage certificates. How to prepare marriage certificates. Maybe that's standard, that's what we're going to talk about it. So advisory council will start the advice. Okay, hello board. You know that in marriage, people are so happy. So everything is happy, 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 right? So let the fair value be high. Because they don't even think about the fair value. Nobody think about fair value. What they think about is what the joy and the satisfaction. So let's build upon the joy and satisfaction. Okay. Then what about the end stage? The funeral. Funeral, you know that the people are also what? Mourning. So what do you do? So that one, let's keep the joy and satisfaction there and let's bring solo items. So these are what? The ideas that the ISB will seek from where? Internally from where? The advisory council. Then sometimes or normally the board they pass a document to the countries or institutions or member states or anyone that uses the IFRS for them to comment on the issues that they have with the existing IFRSs. So ICA Ghana, every year ICA Ghana receive what? Letter from the board, ISB board. So they'll ask that Ghana, please, is there any standard that you find it difficult in your country? Tell us. Any issue that you have. If they don't come and then circulate it, ICA just write to them that, oh, everything's okay. Everything's okay. Oh, we find it something difficult, especially there's one of the standard that we find difficult in the country. That's hedge accounting. IFRS 23. Price level measurement. In fact, in Ghana, you don't even use it much. So that is it. Now that book or that document, anytime the board want to publish a new standard, they'll go and visit that document, and then based on it, the ideas that they're given by the countries, they will take into consideration. So assume that they're going to revise existing standards, they will look at the standard that a lot of people are complaining about and revise it. So for agenda consultation, internally and what? Externally. Internally, they got it from where? Advisory council. Externally, they got it from where? The comment that they receive annually from where? The general public. That's great. Then after they've consulted the idea, they have to plan the work. Okay, we'll start from here. So that's the plan. We start from here, we end there. Okay, this must go in, and then we are done. Who to do the various responsibilities, and then all the other issues. Then there's step two. Is we call it discussion paper. Discussion what? Paper. Discussion paper. Now we call it discussion. That's a step two, discussion paper. I call it what? The skeletal version of the standard. The skeletal what? Version. So after you plan the work, now put it into what? Into writing, and then jot it down. So you it contains the main issues that should be explained in the standard. So such as what? Objective, scope, recognition criteria, measurement basis, disclosure requirements. So that's the discussion paper. This one contains what? The skeleton version. So it just contains the ideas, putting the ideas into what? Into writing. They are done. So the written form of the ideas and the agenda that you've consulted, putting together, you call it what? Discussion paper. Please, here, the board may, the word is what? May. It is not compulsory. They may issue this paper to general public for what? For comment or for review. It's a may, it's not a must. So they can prepare the discussion paper and what? Keep to themselves. They will not tell anybody about the discussion paper. They are not wrong because it's not part of their constitution. So it's a may. So right after the discussion paper, they go to what? The third one, exposure draft. Exposure what? Exposure draft. In fact, the exposure draft is a draft version of the financial statement. Now they've added the fresh to it. Now there's no more escalating. No. They've added the issues. If let's assume that they publish it to the general public commented on it that okay, add this and this and this to it. Now can't we do this? So they take time and then put all these ideas into what? A nice draft. So that's the draft version of the financial statement. In fact, if they accept it, in fact, that's our IFRS. Here, there's a must. It must. Here, there's a must. They must what? Send it to the general public for comment, for review. It's a must. So for a special draft, the board have to send it to what? General or public. Because if care is not taken, you'll be there and then they put something together representing something and they'll just impose it on you. So you have to agree. So that tomorrow you don't come and stand somewhere and say that, oh, that thing I didn't let us see inside. They didn't let us see anything. We're there now, they say IFRS 16. We didn't even know where it came from, IFRS 17, and where they are going. No, they have to let you know. So here they send to member states. Just that in Ghana, when they send it, just that in Ghana, ICA do the commentary on our behalf. So that is it. But let me chip in this. One of the disadvantage of or the barriers to international harmonization is that if there is lack of strong accountancy body, it deter countries from adopting it. Any country that does not have a strong accountancy body, that country will not go in for IFRS. Why? Because people will abuse it. If in Ghana, they're abusing it. And how come we don't have a strong accountancy body? Have you ever seen ICA finding any of the accountancy body or any of the firms? Okay, yes, recently ICA find Deloitte, right? Yeah, we find some of the firms. So we find. Okay, now let's continue. So the exposure draft must be sent to the general public for comments so that they will know the final stage of it. Now let's go to the fourth one, the fourth point, and then you'll be fine. The fourth point, and then you'll be fine. The fourth point. Now the fourth point is that What if there's an issue with the exposure draft? That one, it's a must. It must be sent to the general public. So they'll comment on it. That we don't like it. We don't like these issues. Change it. If they will hear, they're fine. But the fifth one is that revision of exposure draft. Revision of what? Exposure draft. Exposure draft. So it means that they are going to revise until the final draft will be what? Accepted. And then we are done. So let us assume that the final one, the vote accepted it. What do you think will happen? That's the sixth step. So that means after the revision of the last one, or if the final one is being accepted, then they'll do what? Issue of what? New IFRS. Issue of new IFRS. New what? IFRS. So they issue the new standard. So the standard will be issued to the general public. What do you think will happen after the issue? For instance, when they issued IFRS 15 and 16 recently, that's the last standard that they've issued, 15 and 16. 17 is ready. They'll publish it right now and then they will issue it. After the issue now, what do you think will happen? Adoption, right? Yes. So adoption. So adoption of what? The new IFRS. New IFRS. Good. Adoption of new IFRS. So after the issue or the publish, you have to also adopt it. Member states, countries, institutions, corporations, giant international bodies have to adopt it. And then the last stage, post-implementation review. Post what? Implementation review. Implementation review. Now here, this is where the interpretation committee, their work will come in. They have to hold semblance and see whether the requirements stated in what? The standard. People are using it or people are not creating their own version of the requirement or the requirement has been misused, so that they will see whether they will revise it or they'll make any amendment. So that's the post-implementation review. Anyway, they felt like the organization or the institutions or the general public are not getting it well, then the interpretation committee will provide what? Explanatory note to explain the meaning of those requirements. So these are the 8 solid steps that the board or the IFRS's foundation, the board, the advisory, and then the interpretation committee will go through to set up a new standard, the due process. That's good news. On that note, we have successfully finished both conceptual and regulatory framework. Thank you very much. Now I'll take the remaining time, 30 minutes, to go through the questions. So I'll read the questions and then we solve them. So the questions solving stage, and then you'll be fine. So let's see. The first question on the fine. Now let's go to the question solving and then you'll be fine. Great. If you don't have the handout, kindly let me know so that I'll forward it to you and then you'll be fine. So straight to the question section. So I have to go through everything in the handout though. They're very good though. They're very good though. Okay, question 1. You have not reached the. Okay, so question 1. Question 1 says that explain the difference between conceptual and regulatory framework of financial reporting. That's the first question. So explain the difference between what? The conceptual and regulatory framework. I believe strongly that you can do that right. Conceptual talks about what set of principles that guys or that form the base of financial reporting. Regulatory framework talks about set of rules and laws that guides what the financial reporting. We are done. You can go into detail that the conceptual framework moves ahead to prescribe the underlying assumptions and gives us the qualitative characteristics of the financial statement. That is it. Then two, the B, define and discuss the fundamental and enhancing qualitative characteristics of accounting information. So the fundamental, what are they? There are two, right? The fundamental are two, right? And no, they are not two. And then enhancing to our what? Four. So what are the fundamental qualitative characteristics? So fundamental. So let's go to the board. So the fundamental qualitative characteristics, they are two in number. Financial statement, what are they? They are two. They are what? Faithful presentation and what? Relevance. So we explain what a faithful presentation means. Faithful presentation means the transactions or the financial information that we are presenting, it must represent what? The economic reality of the entity. It must represent what has actually happened, not what they thought or what they have assumed. No. No manipulation, no suggestion, no what? Window dressing, big bath accounting. Great. Now you cannot define faithful presentation without the keywords. I normally call them the ingredients or the factors that enhance what? The faithfulness of account. One, completeness. The account must be complete. If you are faithful, write everything. If you are faithful, tell us everything. Good. And then neutral, right? Or unbiased, free from what? All material errors. And then substance or what? Over form. Almighty. Please, I gave a homework on substance over form. Please let me have them if it's ready. Okay. I'll upload it on the platform again. So can you, the question was, let me repeat the question. That remember the question. It was last November 2018. Yes, so for those who have the past question, you can go there. Question 5B. November 2018, question 5B. That's great. Question 5B. Okay. So that's substance over form. You are saying that some of the transaction accounting, the legal form is materially different from what? The substance. So what do? You record what? The substance form. If you want to report faithfully, then the transaction must be recorded at the what? At their substance, but not the form. Great. Then we talk about relevance. So relevance are what? Relevance. The financial statement that we are sending or the information that we are presenting, it must what? Provide all the economic what? All the decision needs of the user, or it must be able to influence the decision needs of the user. So ability of the financial statement to influence the decision needs of the user, that's the relevancy of the information. And normally the relevant information will help what? The user to do what? Predict the future or to confirm the past. And we are done. And we said that you cannot define relevance without the key term. What is it? Materiality. What is materiality? Material. You are saying that materiality is the threshold on which financial statement is being what? Prepared. So what are the items that you have to include? You have to include all the material items. Yeah, you're not saying you should exclude immaterial by if you do mistake on them, we don't normally worry most. So that is it. Now, we said that information is material if it's omission or misstatement could reasonably cause what? A distortion in the economic decision made by the users. So if there's a particular information, when you include it, the owners will think different. If we exclude it, they also think different. If you misstate it, maybe it was 30, make it 50, they also think different. Such information is what? Is material. That is it. And you can assess the materiality by what? By size or by nature. Size, the quantum of it, the value of the item. If you are having, let's say, 50,000 cedis on you, it's your personal money, and you lost maybe 100 cedis or 1,000 Ghana cedis, you just let it go. Everything. You don't care about it. You don't feel. You don't feel. They'll call it a chicken change, right? Now, if your last money now tend to be 50 Ghana, and that one, even if one city, even if 10 city, even if 10 city get lost, cry, you on all the torchlights. Even if daytime, cry, you on torchlight to look for the money, wherever the money is. Why? Because now it's becoming what? Material. It is now material. So that is it. So we are saying that maturity is by what? By size. Looking at the size. Let me cite this WAEC example. They'll tell you that pen is what? Material to who? The lotto forecasters, right? Yes, but it's material to banks and all those stuffs. That's great.
And the banks will tie it to you so that
No.
you know.
No, it's material. Now, the maturity by size. If you check, sometimes let's assume that your 10 CD got missing. You didn't mind because you have 50,000 cedis with you. Your 10 CD got missing. You didn't mind because you have 50,000 cedis with you. Let's assume that every day your 10 CD, every day you are missing 10 CD. Every day you are missing 10 CD. For 2 years, how much? A year alone, you are getting what? 3,650, right? 3,600 and what? By 50. Right now it's material, right? Yes, material. Twice of this getting to 7,000 plus. So it's what? Material. So you are saying that individually the item might not be material, but putting all together, it's what? In aggregate form, it's what? Material. So in fact, in auditing, when you are done, before you issue audit opinion, make sure that all the mistakes that you found, putting all together, or all the errors, putting all the errors together, it will not be material. Because sometimes some of the accountants are smart. They are very smart. Smart one. So they'll be passing the journal entries. They can set a fictitious account where every day 5 cedi will be debiting or be moving, transferring from the company's account to a personal account somewhere. Every day 5 cedi. For 5 cedi there, nobody will track of 5 cedi. But trust you, if you have done this for 10 years, 5 cedi every day, by ten years, by 365, and see the amount that you get. So that is it. And you can also assess majority by what? By nature. Sometimes the amount is not what we use to assess, the nature, how the transaction took place, or the environment. Now, take Ethel Tigo, for example, their measure is material by nature, not by size. Even if they spend 1 Ghana cedi, Ethel pay 1 cedi, Tigo pay 1 cedi upon the measure, it is material, even though 1 cedi is immaterial to them. Why? The nature, the transaction itself make it what? Material. How we get it? Uh-huh. That is it. Like when they say, oh, somebody have gone into money, everybody will beat the person. Because it's what is material by nature, not by size. They don't even care how much the person stole. They say Juro. As long as you hear Juro now, you are going to beat the person. Don't even ask how much the person maybe picked. Maybe the person picked just 1 cedi. But the beating, you don't have 1 cedi beating, 2 cedi beating. It is what? Material by size. So it's material by nature. Because thief by nature, as I say, Juro, they will come, everybody come and beat you. So that is it. That's green. Like for instance, bad debt. So you are done with the fundamental. Then we explain nicely for this for the examiner. The format will be given to you. Then you come to enhancing. Enhancing are four, right? Comparability, understandability, verifiability, and what? All the ET. Understandability, verifiability, and what? Comparability. And then timeliness. Comparability. The financial statement must be compared to the other one, the other entity's financial statement, or the same years, the same company, but what different what years. That's great. And we said that to enable comparability, there must be what? Consistency, or what? Or uniformity. And there must also be what? There must also be what? Yes, I like it. Say it loud. Yes. Hmm. Yes, there must be disclosure. Tell us whatever happened or transferred. That's fine. Then we talk about understandability. The financial statement must be easily or readily be understood by what? By the users. For that matter, we said the users should have a reasonable knowledge about the financial operations of the entity. That's good. Verifiability, I like it. You're saying the financial statement that you prepared, someone should be able to go through, especially what the auditors by a third party. Auditors must go through. So if you pay financial statement, the auditor have to call you every day and ask you, please, I can see 2,000 sitting somewhere. Where from that 2,000? No, that means it lacks verifiability. I like it because in exams, the answer they're going to provide to you must also be verified by what? A third party, usually what? The examiners or the markers. So if you prepare answers for us that cannot be verified, that one you're not doing answer. Yes. Then timeliness. The financial statement must be on time. Not too early, not too late. Then you are done. So I'm done with the first one. So let's go back to the question again. Now, C. Assess the advantages and disadvantages of each of the measurement bases from point of a key user. So here the measurement bases that we did, the four measurement bases. You pick one key user. This question is a pregnant question. So one, you are assessing the advantage and disadvantage. You pick one key user. So let's say owner, or let's say the management team. Then you pick is then you state the advantages of what all the measurement basis to that particular what user. Then you are done. In fact, indirectly, we are just asking you what are the advantages and disadvantages of what the measurement basis. So, for instance, historical cost measurement. That one, it does not show the true or the current value of the entity. That's one what disadvantage. But the advantage is that it's very simple, easy. The figures easy to obtain them. Oh. That one they are there. They are recorded figures. If you go to the current basis, they give a true picture of the entity. However, they are a bit difficult to ascertain their figures. It's not easy as like the historical cost base, and then you move on. So that's how you do to solve the question. Then the B, explain the ISB. The D, explain the ISB's standard setting process, so-called the D process. So that one, first step, agenda consultation. Second step, discussion paper. Step 3, exposure draft. Step 4, revision of exposure draft. Step 5, new IFRS issue. Step 6, adoption. Step 7, post implementation. If you have repeated some of the steps, so you'll be fine. And then E, outline and discuss the advantages and disadvantages of what international harmonization of financial reporting standards, and then you'll be fine. So advantages, you said improve what comparability, right? All these ones they are requesting for textbook knowledge or textbook ideas. Now I'll concentrate more on the practical questions, the one that requires some application, especially like question 2. So question 2, for instance, question number 2. That's Target Fruit Limited. In fact, I'll read the requirement first because there's a person who say rat or RAF. The requirement first, additional information, and then the footnote. Requirement: prepare a brief note for the finance director addressing each of the following using what and using the ISB framework as a source of reference. ISB what framework? What of the framework are they talking about? The conceptual framework. Great. First, identify the potential providers of finance for Target Foods Limited and their information needs or information requirement in respect of the financial statement. So they say providers of finance, so source of finance, providers of finance. So for Target Food Limited, it's a company, right? Once a company can raise shares, so that's one, shareholders. Providers of what? Finance. Shareholders, investors. They can also take what? Loan. So lenders, right? Or bankers or loan creditors. How we get it? Yeah, they're asking for users, but they're asking you specific. You are limited to those that provide finance. How we get it? They can also sell on credit, suppliers. Go and buy the fruit on credit without paying the fare. So also source of what? Credit, or source of what? Finance the organization. We are done. That's all. And then you tell them the information is suppliers. They want prompt settlement of their money and keep within the supplying terms. And you be able to stay in business for long. Loan creditors, you paying the interest. Shareholders are interested in profitability and also interested in their return. The venture holders are interested in what? They're interested. They are the loan creditors. All of them will be form part of the loan creditors and the bank lenders and then the institutional creditors. That's great. So all of them, they are there. Now B, explain the term performance and position. Wow, what is performance? What is position? And identify which of the financial statement will assist the user in evaluating performance and position. So performance is being measured in terms of what your profit or loss. And then the financial statement that we use is what? Profit and loss statement. Yes, everything profit and loss. Yes. And then position. Position simple means the assets and liabilities that you have. Not the position in the market too. Not your position like your class score. No, the asset and liabilities you are done. Which of the financial statements? Statement of financial position, right? We use position to assess your position. Use profit and loss to assess your what? The profit and loss. So that is it. Use profit and loss as that's what we are saying. No, performance is profit and loss. That's good. Hey, the phone is off. So the camera is off. Great. Now let's move on. Great. Let's continue. So we are done with this one. Now let's see. Indicate why for decision-making purposes, the financial statement alone are insufficient. Please, this one is a very topical issue. So I suggest strongly that you know this aspect. It will help you in financial management and management accounting. So let me read the question again. Indicate why for decision-making purposes, the financial statements alone are what? Insufficient. So for decision purposes, the financial statement, you are just asking you about what the challenges or disadvantages of what financial statement. As the name suggests, financial statement. It does not provide information about the non-financial aspects, such as what goodwill, number of employees, customer loyalty, customer satisfaction. All these are not taken into consideration because on the financial statement, we don't see it there. And you need those information to make a good decision. Because product quality will inform you the selling price. Oh. Do you think if Apple phones are like, let's say, Gen 3 or Gen 10, or like, let's say, Techno, would they be prices are high like that? Not at all. So the finance section depends on the non-financial before you make a decision. Quality of information, that is it. So we should take note. And then two, they are based on recorded figures. They are not helpful for what? Predict the future, to make decisions to the future. They are recorded figures, historical cost. So they don't make provisions into the future based on the recorded figures. Unlike management accounting that predicts the future, and then you'll be fine. But again, disadvantage of what? Financial statements. Financial statement. In fact, mostly, tell me, we are in 2020, right? But the most recent financial statement is what? 2019. So if 2019 you make billions of profit and your performance was very good, that means that currently Now that I'm reading 2019 financial statement, is the performance good again? Look at how COVID have turned this around drastically. So if we are good in 2019 and your performance, your financial statement, I have it here, and then I'm reading it, and then you are telling me good profit. Now I'm waiting for 2022. Oh, and see. So tell that, oh, we furnish it to you. We send it to you. So it means that the financial statement alone, I can't base on that one to make decisions today because it does not tell me everything about the company. And it's even past. It does not give the current information, current view. So no financial statement is ready for 2020, except for the quarterly report. But the final financial statement for 2020 is not ready until 2020 goes to an end. Maybe by December, things will turn around and it will change situation. So these are the challenges that we have with what? The the financial statement. And then it's also subject to personal influence. Personal influence. The accountant. Most of the items in the financial statement are estimate and judgment. So if I give you the chance, you judge or you estimate different. If I give the person two chance to do different thing. Yes. So that's why the tax authority does not like the financial statement prepared. They will prepare their own financial statement and tax you on it. That's it. So so that's the end of the question. Please, have you seen how I solved the question without reading through the scenario? That's how it is. So there's a principle called RAT or RAF. It says that read the requirement first. Sometimes the requirement does not need the statement, the story over there. They are just there to throw you away. In fact, studies have proved that most of the case study, the first question normally does not depend on the case. Yes. So that is it. And then you are fine. So you can read the entire show. Target Food Limited. Now question 2. Question 3 is yours. Question 3, I want a full page. Just one page, but you are done. I read the question. I will explain the question to you. I will explain the question to you for question 3, Divs and then Sales Limited. I will explain the question to you, then you will try it for me. I like the question. Now, using IASB framework, define the term asset, liability, and recognized. I like it. So recognized. What's the definition for recognized? What's the definition for asset, liability? And then prepare brief note for Carol Roberts discussing whether the above result in an asset. Okay, resulting whether the above result in an asset or what liability, whether or not they should be recognized in the financial statement. Note that you are not required to refer to a specific IFRSs that may be relevant. Stick to the IASB conceptual framework, that's all. We've not done any standard. So here we're not going to apply any standard. We're going to apply all the principles of what set in the conceptual framework. We are done. Now let's see. So let's see the whole show. But don't be putting your hands close to his mouth. Daves and Sayers Limited, that's D&S Limited. Is a well-known publisher of children's educational books. The finance director, Carol Roberts, is known for her commercial acumen rather than her technical ability. She is therefore seeking your advice. Yes, because know that you are ICA student. On two particular accounting issues. The first issue, value of the head of population. D&S Limited have recently appointed or poached a new head of population. So they have appointed a new head of what publishing, Jane Lancey. Yes. Jane recently worked for a key competitor, Surrey and then Hughes PLC. In fact, all of them are there. Jane is extremely popular. In fact, In Ghana, James will be who cry. Is it Goku back home? The one that normally talk with a small voice. She also old pan. We see plat. Good. Goku back home.
Person cries one small voice.
It's not that one of them. Father known
Only
their
Goku
person.
has a small voice.
Eh. Uh-huh. Now, assuming that you want them to come and be with you, come and then be with your article. You know they are very popular. They've been in the industry for a long time, so they have experience. Good. So Jane is like that. So Jane is extremely popular among the leading authors in the market. Wow. And is sure to attract service of a certain authors currently working for his company. Carol believes that Jane is therefore of great value, in fact it's true, great value, and that such value should therefore be recognized or recorded in the balance sheet or in the financial statement in the form of what? An asset. How we get it? So you see the scenario, right? The guy is very popular.
Jane is a
The guy, Kokubaku is very popular. You say Jane.
this they are doing Jane.
Okay, Jane. The lady is very popular, right? So he have a great value. So do you call his name as what asset in our books? So that is it. So to answer this question, just tell the examiner that to record Jane as an asset in a book, then the following conditions should be there. There must be future accountability flowing from Jane to the company, and that the cost of Jane or the cost involved can be measured what? Reliably. Then you come back again, second paragraph. Even though the benefit of Jane will flow to the entity, however, the cost of Jane cannot be measured reliably. How we get it? You are done. So therefore, Jane should not be recorded in the books as assets. Any amount paid to Jane must be recorded as what? As an expense. That's the wages and salary. You are done. Then you go to issue number 2. Provision for alleged breach of what? Copyright. Alleged breach of what? Copyright. This one is very popular. Alleged breach of copyright. Carol is aware that Poppy Anderson, that's one of DNS authors, is being accused of including ideas in her text that have previously been published. Carol is certain a legal case will ensue, and therefore, being prudent, wish to recognize a liability in the account now for any damages that are likely to arise. So should you record liability? To record liability, there must be two conditions. So we tell Jane. To record liability, there must be what? Two conditions. What are they?
It's
There must be
probable
probable
that
that
the future family
it will result in outflow of what? Future economic benefit, right? Great. Second, the amount involved can be measured what? Liably. So here, even though it might be probable that the legal damages will result to what? Payment of fines or compensation of damages. However, the amount involved cannot be measured reliably. Tell me the amount.
is
In,
having of it.
in fact, Jane or the in fact Carrot does not have the capacity to determine what the amount that you pay. It's in the hands of what? The judge. In fact, all their lawyers have to ascertain that, okay, according to the law, if you breach copyright, you pay 10,000 Ghana cedis. However, we are 70% sure that this 10,000, they will fine you 10,000. So what do? You find 70% of the amount and put it inside. So here, Carl cannot record the liability because there's no what present what obligation, or the cost involved cannot be measured what reliably. You are done. So this is how the answer. This is a question I said I'm looking for the answer. We solve it. Try. No, I thought you said you should go and do it too. Oh, I've solved it too. Okay, it's not anything. I'll give you a different one. So that's how we are going to answer the questions. Now let's go to question 4. Question 4. Briefly state and describe 5 main weaknesses of historical cost and the current cost convention in financial reporting. So historical costs, what are the main weakness about the historical costs and then the current cost convention? Then you tell the examiner, you are done. The main issue with the historical cost is that it does not state what asset and liability will be what under or overstated. Profit will be overstated. Performance, it does not show the true performance of the entity because of the understatement and overstatement of what assets. You are done. Then you go to that of the current cost. Current cost, the weakness is that you find it difficult, a time consuming. Because you have to assess the current value of the asset. It's not easy to get it. Go to the market, get a fair value. Sometimes some of the asset does not have a fair value. Especially asset that is not does not have active market. There's no fair value. Assuming that you have an asset, that asset you can't get in Ghana market. Or in fact, it's like self-manufactured. You can't get a fair value of it. So it's not a common asset. So the current measurement also have some weakness, and then you go for the examiner, and then you'll be fine. Now let's see. Question 5. That's ICA 2011. So this from here going there, the first question will flow. Outline the role and the structure of International Accounting Standard Board. That's ISB. May. That's 2011 May. And then the B one is the November. Measurement is a key criteria underpinning the financial reporting standard. Explain the 4 measurement bases proposed by the ISB conceptual framework. Have you seen? Repeating of question, it has repeated here, right? Great. The role and the structure of International Accounting Standard Board. So what's the role? The functions. So and then the structure. The structure. So the structure, you go to the foundation, the what? The advisory interpretation committee and what? The board. Then you are done. Then you are done. And then you talk about the membership of the board. And then the B, we've talked about the C. First, C is your first homework. This one I will not explain. Question 6. That one I will not explain because if I start explaining it, I may end up solving it. I like question 6. So required, explain the concept of what? Fair presentation and compare it with what? True and fair view. So what's the difference between the word fair presentation and what? True and fair view. Compare them. Explain the concept of what? Substance over form and its relationship with to what? Fair presentation. So that's your homework. And then the third one is explain the circumstances in which not compliance with the detailed provision of an accounting standard will be justified. Hey. So if you don't in Ghana here, even though we are using IFRSs, but if you don't comply with that requirement, you are okay. So you tell us. That's May 2012 ICA. Question 7. So question 6 is yours, please. You just to it for me. Question 7. They've said that a conceptual framework of accounting is what? Coherent system of what? Interrelated objectives and fundamental principles. Wow, I like the definition. Which prescribe the nature, function, and the limit of financial accounting and the financial statement. Required. Outline the 5 objectives. Outline 5 objectives of the ISB conceptual framework. 6 to achieve. 2. State the main content of the conceptual framework. This question was repeated recently, the B part. State the main content of the ISB conceptual framework. The content. Please, the content are the issues that there are 7 content. Content number 1, objective of financial statement. Number 2, underlying assumption. Number 3, the qualitative characters of financial statement. Content number 4, what again? Recognition. Element of the financial statement. Content number 5, recognition. Content number 6, measurement. Content number 7, and then the capital maintenance. We are done. State any of them. State the main content. If I hear you're looking for the other 7, there'll be trouble. If you're looking for the other 7, trouble. Next time. In fact, 5 of them is okay. The last time that it came, they asked for 4 State four content of the financial statement. That came recently. I think a sitting before they changed the syllabus. So the last one, May 2019, yeah. May 2019. Question number 8. ISB framework outline among other issues the qualitative characteristics of financial statements, recognition and measurement of elements of financial statement, etc. Required. Explain the four main qualitative characteristics of financial statement, the four main. 2. Explain the four bases of measuring asset liability subsequent to their initial measurement or the initial recognition. That is the ICA May 2014. And this question, measurement, this is the third time of asking measurement. So formally, the measurement basis there was like frequent. You will see it again. So question 8, I'm adding it to the question 6. So you have to work that you do. Question 9. So I want to finish, scan through all the questions. So please, this set of questions does not include recent past question. That's last two sittings. So I'll compare that one to you and then send that one also to you. I want you to get all questions that IC have asked on conceptual and regulatory framework so that you know the next question. So that you know the next question. How we get it? Great. So I'll do that. Now, question 9. Two of the enhancing qualitative characteristics of useful financial information contained in the ISB conceptual framework for financial reporting are understandability and what? Comparability, the ET. Required. Explain the meaning and the purpose of the above features in the context of what? Financial reporting. And discuss the role of what? Consistency within the characteristics of comparability. So we did this one. That's May 2015. That's quite recent. November 2015. Quite recent. So and then you'll be fine. So here you start. You start explaining what? Understandability. And then tell the examiner that users must understand, must satisfy themselves with what? With the financial issues about the companies. That's all. You go to comparability. You explain. You tell the examiner that before to enable comparability, there must be a consistency. And even if mentioned it here, the rule of consistency. Yes, so that to help maintain uniform basis, it provides a common base where the financial statement can be what compare easily. Then let's go to B. B says that the International Accounting Standard Board, ISB, conceptual framework for financial reporting set out the concepts that underline the preparation and presentation of financial statements for external users. Discuss the relevance and the possible limitation of the conceptual framework for financial reporting, the purpose of the conceptual framework, and then the limitations, all of them. In fact, all these answers are found inside the notes. It came to a sitting. There was a sitting where, in fact, all the questions that they asked was inside these questions. Was among these questions. It was a repetition. In fact, if everybody tells you that most of the ICA, CCA, they don't repeat questions, it's a lie. Repeat questions. But the question that repeats, students don't have upper hand on it. And then there are the question that old question. I say, for instance, November 2018, they repeated 2020 past question. Yes, last attempt to the same thing. In fact, there will not be a year that they don't repeat questions. So the past questions are very good and they are reliable guide.
I think that the concept is
Yes, reliable guide. So that is it.
and the concept you should pay more attention. Me the one. The
You,
last time you didn't fund.
you didn't come.
You didn't do this one that I didn't do.
We did it online. We did it online.
But the other one that came, you didn't really touch on the period.
Great. Okay, so that's good. This one will do it. Now question 10. Yes, question 10. I like question 10. As a new qualified accountant with the Institute of Chartered Accountant, don't tell the examiner if you're not qualified. So you answer the question, I beg. This one there, they are pronouncing it on you. just for examination purposes. Just for the exams. After you finish, you are not a qualified accountant. But don't tell the examiner you are not a qualified accountant. Yes. You are asked to make a short presentation to the rest of the staff in accounting and finance department of your employer who are themselves yet to join ICA as a student. So for those they are yet to come, but you have qualified though, even though you're a student, right? Okay, that's it. Integrity, oh. Integrity, that's great. About the standard setting process adopted by the International Accounting Standard Board. Discuss the standard setting process as adopted by what? The ISB to this junior staff. That's May 2016, quite recent. Then the B, two of the qualitative characteristics. That's the same question that we saw it there. The same, it has been repeated again. So I will not read it again. B has been repeated. Let me go to question 11. The questions are many, so that we can cover more. Exactly 8:35. I'm done. Let me check the number of people on board. Chai. Okay, we have more. Don't worry. Six. The conceptual framework for financial reporting identified faithful presentation as fundamental qualitative characteristics of useful financial information required. Distinguish between fundamental and enhancing qualitative characteristics and explain why faithful presentation is important. I like the question. So fundamental, what's the difference between fundamental qualitative features and enhancing? The fundamental are the one that would make the financial statement useful. So any feature that make the financial statement useful is called fundamental. The enhancing, I know say they brighten the features, they enhance the quality of the financial statement. They don't make it useful, they do what? Enhance it. That is it. And you explain why faithful is what? Faithful presentation is important. Then you are done. B, generally, there are advantages of global harmonization of financial reporting standards to countries around the world, including Ghana. This is May 2017. This is May 2017. Great. Required. Huh? This no. This is May 2017. No. All the questions fit is like we know the year that it came. Yes. This one came May 2017. For November 2017, what they asked, it was the same question they asked, but it was a different version. The question that we read in 2011, that was the question that they asked in November 2017, but you'll be fine, don't worry. Now, identify 3 advantages and 3 disadvantages of international harmonization of accounting standard to a multinational company operating in Ghana. So important of what? International harmonization. 1, improve comparability. 2, transfer of staff. 3, easy access of finance. 4, reduce what? Audit cost. Done. They say 3. 3, 3. It was, I think 5 marks or 10 marks or so. And 3 disadvantages. 3 disadvantages. 1, cultural differences, right? Can you say that cultural differences here? You can say cost of training and retraining. But you have to train the staff to get out use of what the IFRSs. The need of financial reporting, right? Okay, that's good. Now, then what again? What again? Cultural differences, right? Our culture here is not the same as that of the other countries, so it can cause an issue. Then you are done. Now let's go to C. Conceptual framework include measurement basis of the element of financial statement together with the recognition criteria for them required. Explain 4 bases of measurement used in the financial statement. They say May 2017. This question is the 4th time of asking measurement basis. So in olden days, measurement basis was a topical issue, but now they've shifted a little. Now they are asking more practical questions or application questions other than the textbook questions. So this one we've done it. Says so you've done it. Let's go to 12. Yes. Question number 2. And question 3 are the practical questions. Question 2 and 3, they are practical questions. Target Food Limited and then the David Corporation, the one that they ask you, can they record assets? These are the practical questions. These are the questions that they're asking now. They are not asking you. Is it? Now they are not asking you what is, explain, state. No. Identify. Tell us what to do. Can they record it? Tell us. Now these are the questions that we are asking you, not what is, explain, give, explain. No. So question 12. Identify 5 limitations of preparation of financial statement imposed on discharge on accountability of the user. This is November 2017, both A and B. These are November 2017 questions. Yes. So here they are just asking you what limitation of what financial statement imposed on what discharge of accountability to the users of the financial statement. So the limitation of financial statement that we read, it has been repeated November 2017, just recently. Then B, identify 5 points in favor of adoption of what accounting standard. Wow, 5 points in favor. So the good news, the benefit of what adopting what IFRS. When you adopt IFRS, you what improve your performance, like performance comparison will what be improved, and then all those stuff. But you've done well. Let me clap for you. In fact, we've passed the time 5 minutes, but we are ending soon. So you've seen the question. They are very good for health too. And question 13, that's a sitting. That's May 2018. May 2018. May 2018, that's question 13. Required. Distinguish between financial capital maintenance and what? Physical capital maintenance. It came for 6 marks. It came for 6 marks. The marks was 6. So you know, right? Financial capital maintenance talks about net assets, whilst physical talks about operating capacity. Like that. Then you tell more. Question 14 is in ICA question bank. The old question bank, question 14. So, in fact, the old question bank, question 14 is there. That's where I picked that question from. ISB framework for preparation of financial statement to be prepared. Sorry, ISB framework for the preparation and presentation of financial statement to be prepared on a basis that comply with certain accounting concepts, underlying assumption and qualitative characteristics. 5 of these are margin or accrual, substance over form, prudence, comparability, materiality. Required. Briefly explain the meaning of each of the above concept or assumption. So you explain what matching or accrual concept states, substance over form, prudence, then you are done. Now, pay attention to the B part of the question. For most of the entity, applying the appropriate concept or assumption in accounting for inventory, accounting for what? Inventory, specific. Accounting for inventory in an important element in preparing their financial statement required. Illustrate with examples how each of the concepts in A may be application to accounting for inventory. That is it. So that one will be homework number 3. So that's 3 homework. All the application you are doing it. All the application. Question 15 is also there for you. That's the end of the section. So I'll bring the remaining questions. So my questions ended in where? I think May 2018. So I'll bring from November 2018 to last sitting, and then add some suggested questions and then some of the likely exam questions to it. So I'll upload that one. Kindly remind me by the close of, let's say, Saturday, if you have not received that one. That one will contain more recent, the change, because this one is up to May 2018. So meanwhile, the new syllabus start from where? November 2019. So I'll do that for you so that you know how your question will be set for you recent, like in a new era. Thank you very much for coming. If you do have any questions, kindly let me pick them. If not, then this is how far the good Lord will bring us. If you have any question, kindly let me know. If there's no question,